Extendicare is big time profiting from Canada's boomers, and they're paying out some very nice dividends at the same time. Fasten your seatbelts, folks. This is going to be a good one. A big portion of the Canadian population is moving into those golden years where they may require a little extra help. That is where a company like Extendicare comes in. They provide a high in-demand service for Canadian seniors, and that opens the door for investors to make a little money while helping to provide that much needed service. Extendicare was founded back in 1968, and they are one of Canada's largest providers of care and services for seniors, operating long-term care homes and retirement communities across the country. They are technically not a real estate investment trust, but and this is pretty cool. They do share some of the important similarities with REITs. They have a steady cash flow, real estate exposure, and regular dividends, which have made it popular with income-focused investors. Now, here's the good part. When it comes to taxes, their dividends are nothing like a REIT. They are fully Canadian eligible dividends. That's not too shabby. I did mention that Canada's aging population is growing, and in fact, it is aging faster than ever. By 2030, nearly 1 in 4 Canadians will be over the age of 65, creating an unprecedented demand for senior care facilities. And with interest rates starting to decline, Extendicare's heavy investments in infrastructure and its steady dividend payouts could look even more attractive to investors seeking stable long-term returns. A sub to the channel is your source for steady long-term future content. I read through Extendicare's recent annual report, and as usual, I have a few highlights I would love to share with you. In 2024, Extendicare posted $75.2 million in net earnings, which, well, that more than doubled their values from 2023. They purchased 9 Ontario long-term care homes, adding valuable real estate to their balance sheet and, of course, reducing lease liabilities. But finally, they paid $40 million in dividends, demonstrating their ongoing commitment to shareholders even during a year of significant capital moves. This is all great, but we are going to need to dive into those fundamentals. If there are numbers involved, we need to call on the graph guru general, the mighty multiplication master, the one and only Mr. Math. We will start off with a little bit of their surface data. At the time of recording, their current value is coming in at $13.03, and they've got a market cap of $1.09 billion. That beta looking at 1.29. That basically means they're 1.29 times more volatile than the market average. On to those earnings per share, they're coming in at 0.86, and their price to earnings ratio coming in at 15.15. Now, the average amongst their peers, that comes in at 23.7. So a few of those peers include Sienna Senior Living. They have a PE ratio of 38.5. And Lauer Healthcare Group, they have a PE ratio of 23.9. And Medical Facilities with a PE of 14.2. Looking at their price to book ratio, that comes in at 8.65. Amongst those same peers, the average is 3.0. Now, their return on equity, this looks fantastic, 70.86%. Holy banana bread. I really dig that number. And their return on assets, that's coming in at 9.98%. Another very solid number. I do overall like the numbers I have seen thus far. Okay. Let's peel back another layer and take a look at their cash situation. They have a revenue of $1.47 billion per year. Their earnings are coming in at $75.21 million, which we did mention a moment ago. And I said those numbers more than doubled. Well, you know what? Those earnings actually increased by 121.3%. That's not too shabby. It is very awesome for sure. Their profit margin sitting at 5.13%. On to their free cash flow, that's coming in at $101.69 million. Operating cash flow, $143.64 million. Let's take a look at that fair value. So their current value, once again, $13.03. Using a discounted cash flow model, we get a fair value of $38.49. So that does paint them as being undervalued by, well, 66.4%. Their 1-year target, that's coming in at $13.54. So analysts are expecting a 5.1% increase. I think they're a little on the low side, but it's hard to say. We got some economic we got some economic headwinds coming our way that might keep it in line with this number. Once again, the numbers are looking fantastic, and I suspect they may have the math to fare well through any economic downturns that are coming our way. Okay, let's turn the page and take a gander at their returns data. When it comes to their dividend, they have a yield of 3.727%. That's a monthly dividend of 4 cents per share. Payout ratio on that, 55.81%. Now, their 5-year average dividend increase, it is 0. That dividend has been 4 cents for a very long time. It's a good, stable dividend. And as much as I'd love to see it maybe peak up to 5 cents, I don't think there's a huge chance of that. I think they're very happy with where they're at right now. Okay, looking at their returns, on their 3-year return on investment, that comes in at 64.31%. Factor in those dividends, we get a total return of 81.97%. On that 1 year, return on investment, 95.53%. Add in the dividends, total return, 103.77%. Holy banana bread. They owned the last year for sure. Their 3-year annualized, that is coming in much lower, 22.09%. But keep in mind, though, that annualized number does not factor in their dividends. These numbers are as good as they get for a dividend growth stock. Okay, let's take that final dive into their debt data. They have a total debt of $278.31 million. And their total equity, $124.35 million. So that is a debt to equity ratio of 223.8%. That is a high debt to equity ratio for sure. But they did actually drop it from 407.9% over their last 5 years. That alone is really good. Also keep in mind, they do hold mortgages, so debt is a part of their game. So it's really not a bad debt to equity ratio at all. Okay, looking at their cash and cash equivalents, that is coming in at 121.85 million. So that's not bad. I like that. I like that quite a bit because it does give them more room in their moat for sure. On their short term, their assets are coming in at 243.70 million. Liabilities just a little higher, 292.88 million. I sure would like to see those reversed, but they're close enough that I can definitely live with them. On to that long term, those assets are coming in at 476.09 million. Liabilities, 302.55 million. That's not too shabby. I'm okay with that one. This debt it's actually pretty good considering they need to use debt to fund more real estate purchases. I will also add that it is well covered by their operating cash flow, and the servicing is well covered by their EBIT. So those earnings before interest and taxes. Now, in regards to share dilution, it's not even on the board for this company. So you don't need to worry about that at all. I do feel that we have enough data for that final verdict. I do love this stock as they really have proven themselves in the past few years to be a great total return option. Without a doubt, they have made a huge splash, and those investors lucky enough to have gotten in early are loving it for sure. Of course, the next few years will not be anything remotely like the last few years, and that does raise questions. Can EXE cope well with tariffs and a possible recession? I do believe they have a big enough moat to weather quite a bit. Luckily, they are not going to be directly impacted by the trade war, but like everyone else, they will take some collateral damage. Their clientele are not going away. In fact, demand will be increasing. And in that sense, they will have a good amount of safety in the form of a consistent cash flow, and that will provide them with the protections to weather the coming storm. They are going to be fine. With that being said, they are a great option for a total return portfolio, and their continued growth and dividends, I think it's still going to be impressive. I do expect their growth to come in smaller during the economic downturn, but in a sea of red, they may be one of those green spots. If you are interested in Extendicare, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on the big six banks. Thank you for watching, and I will see you in the next video.